Welcome to the Opening Bell Report.
You know, there's a bedtime story that Wall Street has been telling itself for, 40 years? It's basically a ghost story for investors.
Let me guess. Is this the one about the cycle?
That's the one. It goes like this. Memory chips are a commodity. They're basically wheat or pork bellies or crude oil. They have a massive boom where everyone feels like a genius, and then they have a spectacular bust where everyone loses their shirt. It's gravity. What goes up must come down.
And a lot of people were convinced the bust was here.
Exactly. A lot of very smart, very wealthy people were shouting from the rooftops that the party was officially over.
It's the classic bearish thesis, right?
Yeah.
The argument is that memory makers have absolutely zero pricing power. They're just riding these waves of supply and demand.
And usually right when things look their absolute best, that is exactly when the wave crashes.
The peak earnings theory.
Right. But then you get a document like the one we're breaking down today. We're looking at a deep dive analysis of Micron Technology's Q1 fiscal 2026 report.
And this report, it doesn't just poke holes in that bedtime story.
It takes a flamethrower to it.
It really does. I've read a lot of these analyses, and you usually see cautious words, steady, incremental. The language in this report, which is dated January 20th, 2026, by the way, is completely different.
What's it saying?
It's using words like shock, paradigm shift, and the big one, super cycle.
Super cycle. It sounds like a marketing buzzword, doesn't it?
A little bit, like something a crypto bro would yell at you.
But we are going to unpack why. In this case, it might actually be the technical truth. We're talking about a stock that just hit an all-time high of $362.
Driven by a headline number that frankly shouldn't be possible for a boring commodity company.
57% revenue growth.
That's the number that stops you in your tracks. 57% year over year.
Exactly. Micron just shocked Wall Street again. So the mission for this deep dive is to figure out if the rules of the game have actually changed. Are we looking at a bubble? Or has AI fundamentally broken the old boom and bust cycle for memory?
That is the crux of it. We need to determine if this time is actually different, or if investors are just walking straight into a trap.
So let's start with the scoreboard. Because before we get into the sci-fi tech and manufacturing yields, we need to ground this in the hard numbers.
The numbers that dropped on investors' desks.
We mentioned the 57% growth. To put that in perspective for you listening, most large-cap hardware companies are popping champagne if they hit 10 or 15%.
57% is hyper-growth territory. It's startup numbers.
It is. And context is everything here, because leading up to this report, the whisper numbers on the street were actually kind of negative.
There was this real fear that the AI trade was cooling off, that the data center build-out was slowing down because, how many chips can you really buy?
And then Micron walks in and reports what? $13.64 billion in revenue for the quarter?
Which is a massive beat. But I want to draw your attention to something further down the income statement. Revenue is vanity, right?
Right. You can sell dollar bills for 90 cents and have record revenue.
Exactly. You have to look at the gross margin to see if the business is actually healthy.
I'm looking at it here in the report. 56.8%.
That is the number that matters. For a hardware manufacturer, someone who has to build massive factories, buy raw silicon, run these incredible clean rooms, a gross margin approaching 60% it's unheard of.
So it tells you they aren't just selling more chips.
They're charging a premium for them. They have massive pricing power.
And that flows all the way to the bottom line. Earnings per share came in at $4.78.
Which absolutely crushed the estimates. And this is why the stock reacted the way it did. The market prices in expectations.
The expectation was slowdown.
And the reality was acceleration. When that gap between expectation and reality is so wide, you get a violent repricing. That's why we saw that vertical move on the charts at 362.
Okay, so the what is clear. They made a boatload of money. But the how and the why, that's what we need to figure out.
Yeah.
Because you don't get 57% growth selling standard memory cards for like digital cameras or laptops.
No, standard memory, what we call DDR4 and DDR5. That's doing fine. It's a healthy market, but it's not doing this.
So what is?
This engine is being driven by one very specific acronym that we see all over this analysis report, HBM3E.
HBM3E. It sounds like a droid from Star Wars.
It kind of does, yeah. But apparently it is the most important thing in the chip world right now.
Okay, so break that down for us.
It stands for high bandwidth memory. And honestly, it's the most critical component in the entire AI stack.
Explain that, because I think most people picture a chip as just a flat black square. Why is this specific type of memory so special?
Okay, think of an AI processor like NVIDIA's latest Blackwell or Rubin chips as a Ferrari engine. It's incredibly powerful. It can crunch massive amounts of data in a split second.
Okay, following.
But an engine needs fuel. In computing, data is the fuel. Traditional memory is like trying to fuel that Ferrari with a garden hose.
Oh.
The engine is thirsty, it wants to go 200 miles per hour, but the hose simply can't push the gas in fast enough. The Ferrari ends up just idling, waiting for fuel.
And that's a bottleneck. A very expensive bottleneck if you spent $40,000 on that GPU.
Exactly. HBM3E is like replacing that garden hose with a fire hydrant. But the way they do it is fascinating. They stack memory chips vertically, literally on top of each other like a skyscraper.
Wait, on top of each other?
Yeah. And they punch thousands of tiny holes through the silicon layers to connect them.
They punch holes through the silicon?
Yes, they're called TSVs, or through silicon vias. By stacking them and connecting them vertically, they create these massive highways for data to travel instantly. It lets the memory feed the beast fast enough to keep it running at 100%.
That sounds incredibly difficult to manufacture. I mean, we're talking about microscopic precision here.
It's an engineering nightmare. You're dealing with alignment at a nanometer level.
No.
If one layer's off by a hair, the whole stack is it's trash.
And heat must be a huge issue.
Huge. You're packing everything so tight. It's like a layer cake that generates its own heat.
Which brings us to the kill stat in the report. It says Micron is currently the only player making HBM3E efficiently enough to meet demand. How is that possible? I mean, Samsung and SK Hynix are giants. They've been doing this forever. How are they missing this?
This is the nuance that the market missed until now. Samsung is huge, yes, but the report highlights that they're struggling with yields.
Define yield for the non-engineers listening.
Yield is simply the percentage of chips that actually work when they come off the assembly line. If you make 100 chips and only 40 work, your yield is 40%.
Which is disastrously expensive.
It is, because you spent the money to make all 100, but you can only sell 40.
So while Samsung is basically throwing away silicon because their process isn't dialed in,
Micron is executing. They took a gamble a few years ago on a specific manufacturing node. They call it 1 beta, and it paid off. They are getting high yields on a product that is incredibly hard to make. They solved the heat issue, they solved the stacking issue.
And the report mentions a massive consequence of this. It says Micron has sold out their HBM capacity through the end of 2026.
Think about the leverage that gives you. We are in January 2026. If a customer, say a massive cloud provider, comes to Micron today and says, I need high-end memory for my new data center, Micron basically says,
Take a number, we can talk in 2027.
Exactly. That's the definition of job security.
It's more than security. It's a monopoly on time. If you're Microsoft or Meta or Google and you need to train your AI model now.
You can't wait for Samsung to fix their yield issues. You have to pay Micron whatever they ask.
So this supercycle isn't just about demand being high. It's about supply being artificially constrained because the tech is so hard to build.
Precisely. It's a supply shock and a demand shock hitting at the exact same time. That is the recipe for an explosion in price.
I want to pivot to a metric that the report flagged as overlooked. We talk about revenue and earnings, but the analysis spent a lot of time on cash flow efficiency.
Which is smart.
Why focus on that? Isn't profit enough?
Because cash flow is truth. Earnings can be manipulated with accounting tricks, depreciation, amortization. Cash flow is just, did money actually enter the bank account or leave it?
And the comparison the report made was startling.
Yeah.
It looked at 2023 versus 2026.
All right. In 2023, the industry was in a slump. Micron was burning cash, literally losing money just to keep the lights on. It was a scary time.
That's the bust part of the old cycle we talked about.
It is. And now
they are generating $29 of free cash flow for every $100 in sales.
a 29% free cash flow margin.
Is that good? I mean, what's normal for a company like this?
For a hardware company?
Yeah.
It's astounding. Hardware is capital intensive. You have to buy expensive machines, build factories. Usually you're happy with 10 or 12%.
So where would you see a 29% margin?
That's what you expect from a software company like Adobe or Salesforce companies that just sell code and have almost zero overhead.
So Micron has the economics of a software company, but the moat of a hardware manufacturer.
That is the quality argument the report is making.
Yeah.
If you have that kind of cash generation, you build a fortress. You can invest in R&D faster than your rivals. You can weather any downturn.
It completely changes the risk profile of the stock.
Totally. It's no longer just a commodity play. It's a cash compounding machine.
Okay, I want to play devil's advocate here
Yeah.
because I can hear the skeptics and the scarred investors screaming at their speakers right now.
Go for it.
The stock is at $362. It's at an all-time high. The PE ratio, price to earnings, is sitting at 34.
Which historically is the danger zone for memory chips.
Right. The textbook rule for cyclical stocks is buy when the PE is high because earnings have crashed and are about to recover, and sell when the PE is low because earnings have peaked.
So a PE of 34 suggests we're paying a massive premium.
Is the report just ignoring that?
No, they tackle it head on. They call it the expensive myth. And the way they debunk it is by looking forward, not backward.
The forward PE.
Yes. Remember that acceleration we talked about? Earnings aren't just stable. They are projected to basically double over the next 2 quarters because of that pricing power and the HBM3E rollout.
So the E in the PE ratio is about to get a lot bigger.
Drastically bigger. When you factor in the projected earnings for the rest of 2026, the multiple drops from 34 times down to 18 times.
18 times earnings. That sounds surprisingly normal.
It is. Now, compare that to the rest of the tech sector. NVIDIA trades at 35 or 40 times. Palantir trades at 50.
Even slower growing tech giants trade in the 20s.
So for a company growing revenue at 57%, paying 18 times earnings is
a steal?
The report calls it a steal. And logically, it holds up. If you believe the growth is real, and that sold-out order book says it is, then the stock is actually cheap relative to its future cash flow.
It's fascinating. It's almost like the market is suffering from PTSD. They remember the crashes of the past, so they're afraid to value Micron like a true AI growth stock.
That is the inefficiency that the report is identifying. The market is pricing it like a cyclical commodity, but the company is performing like a secular compounder. That gap is where the opportunity lies.
Let's look at the charts then. Because fundamentals are one thing, but price action tells us what people are actually doing with their money.
Right.
The report uses the term blue sky territory.
I love that term. It sounds optimistic, but it's actually a rigorous technical analysis concept. When a stock hits an all-time high, breaking past 362, something interesting happens psychologically.
What's that?
There is no overhead supply. Think about it. If a stock was at $400 3 years ago and dropped to $300, there are people who bought at $400 who are just desperate to sell to break even.
They create resistance. They're bag holders waiting to exit.
But with Micron at an all-time high,
everyone who holds the stock is in profit. Nobody's looking to get their money back. They're all happy.
Which means there's very little selling pressure. The report describes the trend as vertical because there's zero resistance.
However, and the report is very responsible here, it warns against FOMO, fear of missing out. It says, don't chase green candles blindly.
Which is just good life advice, really. Nothing goes up in a straight line forever. Even in a super cycle, you have profit taking.
You have days where the market just feels grumpy.
Exactly. And the report suggests a specific golden opportunity zone.
They're looking at the 340 to 350 range.
Yeah. If the stock pulls back to that level, the analysis suggests that's not a panic signal. That is a retest of the breakout.
So if you see red on the screen and it hits 340, that's not the time to run. That's the time to load up.
Exactly. You want to buy the dip in a strong uptrend. Don't buy the euphoria. Buy the consolidation.
And where do they think this goes? Because 362 is already high. Did they raise the target?
They did. The new price target is $420 by the summer of 2026.
$420. That's another 15 to 20% upside from here.
And based on that 18 times valuation we discussed, $420 isn't crazy. It would simply mean the stock is keeping pace with its earnings growth.
It doesn't even require multiple expansion.
No, it just requires the company to hit the numbers they've already promised. It feels like a very pragmatic bull case. It isn't hype, it's arithmetic.
Before we wrap up, I want to zoom out. We've been deep in the weeds of yields and PE ratios. But there's a bigger story here about the hierarchy of the tech world.
Go on.
For the last decade, the power has been with the designers. Apple, NVIDIA, AMD. They design the chips, the magic, the logic.
And the manufacturers, the Microns and TSMCs, were viewed as the help.
Exactly. Just the plumbers who put the pipes together. Low margin, high labor, replaceable.
That was the perception.
But this report ends with a really provocative question about a power shift. If Micron is the only one who can efficiently feed the NVIDIA beast, does the plumber start calling the shots?
I've been thinking about this a lot. In economics, value accrues to the bottleneck. If you have the scarce resource, you have the power.
And right now, HBM3E is the scarcest resource in AI.
Think about it. NVIDIA can design the fastest chip in the universe. But without Micron's memory, it's a paperweight. It cannot function.
That dynamic changes the negotiation table.
Totally. Micron isn't asking for orders anymore. They are allocating supply.
Allocating supply. That is a polite corporate way of saying, we decide who gets chips and who doesn't.
And that suggests that we might see margins go even higher. We might see Micron becoming a strategic partner rather than just a vendor. If that happens, the valuation gap between NVIDIA and Micron has to close.
The report actually threw out a final, slightly cheeky question for the road. Will Micron hit 400 before NVIDIA hits 200?
Which implies either a stock split for NVIDIA or a massive correction. But the sentiment is clear. The momentum is shifting to memory. The boring stuff is suddenly the main event.
It's a heavy concept, the idea that the plumbing of the computer is now the most exciting trade on Wall Street.
That's the nature of technology. Bottlenecks shift. The key takeaway from this deep dive is that the memory industry isn't just a commodity cycle anymore. It's become a critical infrastructure play.
So to summarize for our listener, the financials are elite. 57% growth is real. The moat is real because manufacturing this HBM stuff is incredibly hard.
And Samsung is struggling.
And Samsung is struggling. The stock is technically in blue sky territory, and the valuation, surprisingly, is still cheap if you look 6 months out.
And most importantly, don't let the ghosts of cycles past scare you out of the future. The data says this time is actually different.
Do not let the bears scare you out of generational wealth. That was the sign-off line in the report.
A bit dramatic, maybe. But when you look at the opportunity cost of missing a shift like this, they might be right.
Well, we will be watching that 340 level closely. Thanks for breaking this down with us. It's rare to find a story where the numbers and the narrative align so perfectly.
Always a pleasure to dig into the data.
And to you, listening, keep your eyes on the plumbing. Sometimes that's where the gold is hiding. We'll catch you on the next deep dive. Stay curious.
Don't forget to like, share, and subscribe for more.